Okay. On behalf of the LKY School, it's my privilege to welcome Dr. Subir Gokarn, Deputy Governor at the Reserve Bank of India, who's going to be talking about a topic with an intriguing title, Global Shocks and Asian Absorbers, Some Hypotheses and Their Implications. Let me, just before we begin, for those of you who have never met Dr. Gokarn, let me just very quickly give you a sense of his background. He was appointed Deputy Governor at the Reserve Bank, I think, late last year. His portfolio is monetary policy. He also deals with statistics and information management. He deals with economic research and analysis and a couple of other elements. Before joining the Reserve Bank, he was at Standard & Poor's and at the Indian rating agency, and I presume this was once an acronym, CRISIL, Credit Rating of India.
Everyone's forgotten that it's a CRISIL.
Yeah. Maybe deep down in history in the past it was an acronym. Anyway, he worked for Standard & Poor's and for the Indian Credit Rating Agency. He graduated bachelor's honors from Mumbai. He went to the Delhi School of Economics. He has a PhD from Case Western Reserve University, USA, and under a Fulbright research scholarship, he spent a year at the Economic Growth Center at Yale University, New Haven, Connecticut. In addition to being at the central bank at the moment, in addition to his academic background, he's also been a regular contributor to a fortnightly column on current economic issues in the Indian Business Standard for the past 13 years. Well, look, anyway, we're very pleased to welcome you to this public lecture. Dr. Gokarn has indicated that he will talk for around 30 to 35 minutes, following which we'll open the floor to questions. This session is being recorded, and could I ask, when you pose your questions, you give your name and affiliation. And please keep your questions, as they say politely, succinct. Thank you. Welcome.
Thank you, Professor Adams. Good evening. I'm going to sit and read, if you don't mind, since it's a more comfortable arrangement. It's a great pleasure for me to be here. I would like to thank the LKY School of Public Policy for organizing this event, and thanks to all of you for attending. I've been in my current role for a little over 6 months now. This has been, as you would all agree, a period of enormous complexity. While there are clear signs of a consolidating recovery, particularly in this part of the world, the feeling that all is not quite well yet has always been present, and if anything has become stronger over the past few weeks. The shock that hit the global economy in 2008 was extremely severe, and it took virtually all the capacity of governments and central banks, and perhaps some that they didn't quite have, to deal with it. This has, of course, provided the basis of the recovery that I referred to, but at this point in the process, as aftershocks of even moderate intensity appear, their impact could be intensified by the diminished capacity of governments and central banks to respond adequately. From a global perspective, we are still in a phase of vulnerability and should not take the recovery for granted. But as we move from this broad global assessment to the prospects of specific regions, the one thing we can draw some comfort from is the performance of Asia. Against the backdrop of persistent uncertainty in the mature market economies, this region is increasingly showing signs of quick reversion to its pre-crisis trend growth path. While I don't want to underplay the potential threats from turbulence outside the region, and we seem to be seeing that on a daily basis. I think that there are good reasons to believe that the Asian recovery and its sustainability are the consequence of forces within the region. To that extent, its vulnerability to what is happening in other parts of the world may be somewhat less. This essentially is the context for my remarks today. As the crisis of 2008-2009 is subject to deeper and deeper analysis, the question of why Asia, despite relatively high levels of trade and financial integration, emerged relatively unscathed will be a central one. Building up a set of dependable shock absorbers will clearly be a primary objective of all governments and central banks around the world, and an understanding of how Asia did it will be a key input into that process. What I propose to do today is to talk about a few factors that, in my judgment, contributed to the region's ability to absorb the shock with relatively little damage. But before I begin talking about those factors, let me provide a brief backdrop with reference to how some of the major economies in the region performed during the recent crisis. On slides 1 to 3, which I'm going to show now, I will talk about this issue. These slides display the year-on-year quarterly growth rates for a number of economies beginning in the mid-1990s to enable some comparison with what was then called and is still referred to as the Asian crisis. Slide 1, which is on now, has the graphs for the three big economies in the region: China, Japan, and India. There is no clear parallel, as the pictures show, between the way in which these economies performed during the Asian crisis and during the recent one. Apparently, domestic rather than external factors dominated their growth performance in the late 1990s. However, the recent crisis clearly impacted the growth performance of all three economies in relative terms. And of course, there's a bit of a scaling issue there. But when you look at the V shape that is sort of visible in all pictures, clearly all of them did suffer a contractionary impact during the recent crisis. Slide 2 displays the patterns for the three countries that were most seriously affected by the Asian crisis in 97-98. These are Korea, Thailand, and Indonesia. In the first two, that is Korea and Thailand, there is a clear parallel between the crisis periods. Growth experienced a sharp dip, but also an equally quick recovery. By contrast, Indonesia was hit quite hard by the Asian crisis, but was apparently impacted relatively little during the recent one. Slide 3, to complete the story, shows the growth pattern of four other Asian economies: Singapore, Malaysia, Philippines, and Taiwan. Singapore, Malaysia, and Philippines again show broadly similar patterns during the two crises. And Philippines, clearly, if you can see the picture up there, is a W in both respects, although a very minor blip. Taiwan was apparently not severely impacted by the earlier crisis, but did slow down significantly during the recent one. The similarities and differences over time and across countries can be analyzed from a variety of perspectives. But since I have brought them into my presentation only to provide a backdrop, I would like to extract two messages from these patterns which have some significance for what I will say subsequently. First, the recent crisis appears to have had a more uniform impact on this set of economies, the exception being Indonesia, but it is a much more uniform pattern in this crisis than in the previous one, which was then called an Asian crisis, but apparently wasn't really a fully regional phenomenon. The so-called Asian crisis actually had a relatively asymmetric impact, with several economies not seeing significant slowdowns in growth, if at all. By contrast, the recent crisis seems to have induced relatively sharp slowdowns in all the countries, barring Indonesia. Second, the recovery in all the affected countries has been very quick. The debate on the alphabetics of the recovery, V, U, or W, has been firmly resolved, at least in this region, with an overwhelming vote for the V. It is essentially these two commonalities which provide a basis for thinking about the whole episode in regional terms. That is, that there is a set of common forces of factors that operate in the region and which gave the unfolding of the crisis a distinctive regional character. Let me now turn to some such factors. The first of these factors is what I would label policy, capacity, and response. It is not strictly speaking a regional factor because clearly virtually every government and central bank in the world did virtually the same things once the crisis was acknowledged. But at the same time, we have to recognize that the simultaneity of actions by these entities in the region provided a significant regional safety net, which allowed the two other factors that I will talk about to work more effectively. Throughout the second half, and particularly the fourth quarter of 2008 and into the first half of 2009, central banks lowered policy rates and accompanied this with massive infusions of liquidity into their financial systems. The magnitude of these changes across countries is depicted on slide 4. The backdrop to these relatively large changes is that most of these banks had actually been moving steadily in the opposite direction in the first half of 2008 in response to the inflationary pressures being exerted by energy and food prices. On the threshold of the Lehman Brothers collapse in September 2008, most banks had moved rates up to levels far more consistent with an overheating situation than a recession. As commodity prices dropped sharply, the rapidly deteriorating economic situation provided the room to move aggressively on rates and liquidity in all countries. However, it was also widely recognized, that monetary actions could be relatively ineffective in a recessionary situation, and that a massive, reliable demand stimulus could only come from the fiscal side. By and large, the fiscal situation in the region was very strong. Governments, therefore, did have the capacity to initiate relatively large fiscal actions without suffering a loss of credibility. Slide 5 displays the range of fiscal policy responses across the region, most coming in the fourth and first quarters of 2008, 2009, respectively. Obviously, the relative magnitudes vary considerably, influenced by differences in domestic institutional mechanisms as well as perceptions about the severity of the problem. But keeping these differences in mind, I would like to highlight the extremely strong actions taken by the Chinese government in November 2008, because this links up with the third factor that I will come to later. Looking back over that period, I think it is possible to see the strong complementarities between the monetary and fiscal actions that were taken beginning in late 2008. As a result of massive capital outflows from the region, Asian economies experienced a severe liquidity squeeze, which, if prolonged, could have done damage to economic activity. There are innumerable anecdotal accounts of how businesses had to lay off workers, shut down facilities, and default on obligations because they just couldn't access finance. The massive infusions of liquidity by regional central banks provided relief over the course of a few months, allowing businesses to at least maintain operations. While this was going on, the finalization of fiscal stimulus packages gave businesses the assurance that demand for goods and services would not dry up completely. As this money began to be spent, business prospects improved, which in turn could be translated into production and employment decisions on the basis of easy liquidity. As I said earlier, this factor, while common to the region, was not really a regional factor. What it did was to facilitate the contribution of two other factors, which I shall talk about next. The next factor I refer to as financial buffers. There is unanimity that the core cause of the recent crisis was the buildup of risks by globally active financial institutions without the capacity to mitigate or offset them. The details of the story are well known, and I will not go into them here, but there is an essential message from the story and an essential difference between the overall structure of risk profiles of the financial systems in the most affected countries and those across Asia. The message is that the viability of both individual financial institutions and the system as a whole is threatened by the disconnection of risks inherent in assets and liabilities. Institutions that borrow their funds from individual depositors or wholesale sources undertake to redeem them under all possible economic scenarios. By any reasonable standard of prudence, they just cannot deploy these funds into channels in which their entire value can be wiped out by market volatility. There are two aspects to such a standard. The risks of any lending or investment have to be clearly identified and quantified, and prudential norms have to provide adequately against these quantified risks. It is apparent from the recent crisis that the whole framework simply did not recognize and consequently respond to the massive buildup of risks. The links between sources and uses of funds became more and more complicated, compounding imbalances between the obligations to repay sources and the risks embodied in uses. However, for a variety of reasons, Asian financial systems in general had not moved as far down the road towards such imbalances, even as the financial systems in the region have developed and matured considerably over the past few years, particularly with respect to their ability to effectively absorb large capital inflows. There are many traditional features that have remained. In retrospect, it is the persistence of some of these features that help financial systems in the region play the role of a shock absorber. There are several ways to demonstrate this, each with its own limitations on comparability across such a diverse set of countries and regulatory systems. So I present the data on slide 6 with some qualifications. I don't have a clear benchmark with reference to these ratios as to what constitutes good, safe, and prudent behavior. However, I would argue that traditional banking practice requires a reasonably close matching between deposits, on which the entire risk is assumed by the bank, and loans, which traditionally are typically made against tangible collateral, which the bank can possess in the event of a default. Obviously, this is a rather simplistic description of prudent banking, but it emphasizes the essential principle of balance between risks in the sources and uses of funds. Slide 6, which is on now, indicates that Asian banking systems have been and still are relatively lending-dominated systems. In virtually all of the countries listed on the table, the proportion of loans in total assets is relatively high. Of course, loans can go sour and sometimes do, but the bank will have a claim on the assets against which the loan is made. On the other hand, while making investments, the bank essentially takes on the risk that the price of the asset being invested in will fall. If this happens, the loss has to be written off the bank's balance sheet. In short, banking systems in which this ratio is relatively high are presumably less exposed and vulnerable to changes in asset prices. The second indicator on slide 6 reinforces the impression of the banking system in these countries being relatively safe. Banks in these countries have apparently persisted with the practice of deploying most of the money they have raised from depositors in the relatively safe channel of loans. This indicator is obviously greatly reassuring to depositors who see it as evidence of their money being relatively safe. Even in a business downturn, the stability of the system is therefore not subject to serious skepticism. In my view, these characteristics of the region's banking systems played an important role in the resilience of these economies. One of the most damaging developments in the financial systems of the badly hit economies was the so-called credit freeze. Essentially, banks had to take such large blows to their balance sheets as asset prices tumbled that their capacity to continue to supply credit to businesses and consumers simply disappeared. Money had to be raised not to do more business, but to shore up collapsing balance sheets. In this situation, liquidity enhancements by central banks have less impact because the financial system cannot pass them on to businesses and consumers. On the other hand, banking systems that had relatively little impairment of their balance sheets, as was the case with the Asian systems, could and did pass on the increased liquidity to users of funds. Therefore, the aggressive actions of the central banks in the region did achieve their desired objective. Money flowed quickly to businesses and consumers who were being starved of liquidity. I think that the capacity of the region's financial systems to transmit the liquidity stimulus through to the economy was a significant contributor to the region's ability to absorb the global shock and display the resilience that it did in the V-shaped recovery. Let me also speak about another dimension of the region's financial shock absorption system. The issue of foreign exchange reserves has received great attention in the post-crisis debate. The role that these may have played in exacerbating global imbalances which then contributed to the precipitation and global spread of the crisis, will continue to be debated. I don't want to engage in that debate in this particular forum. What I would like to emphasize is that one lesson that Asian governments took from the Asian crisis was that some form of credible self-insurance was an essential requirement to be able to deal with such shocks in the future. As the degree of exposure to global trade and financial systems increased, a larger quantum of insurance would probably be seen to be required. Slide 7 shows the influence of this thinking on the accumulation of reserves by the countries in the region. The capacity that these created to allow these economies to withstand large capital outflows over a period of time, while policy responses were being put in place in late 2008 and early 2009, was visible for all to see. I want to re-emphasize the limits to the point that I'm making. Reserve accumulation and its corollary, exchange rate management, obviously cannot be seen solely from the perspective of risk mitigation and shock absorption. As a global debate on the issue is highlighting, there are various cross-country implications of the strategies followed by individual economies, particularly large ones. Eventually, all the positives and negatives will have to be netted out to be able to decide on an efficient and mutually acceptable regime. But at the same time, we should not underestimate the contribution that the reserves in the region made to its capacity to absorb the shock of the crisis and minimize the disruptions in economic activity that some countries saw in the wake of the earlier crisis. The third factor that I want to talk about here is the role of increasing regional integration. This is the factor that gives a genuinely regional dimension to the discussion. The story is simple. This has been a region of relatively high growth for the past decade. Two of the fastest growing economies in the world over that period are located here. In this scenario, every country that is interested in accelerating its growth would strive to take full advantage of the fact that its neighbors are also doing well and that their markets offer an additional opportunity. This is an attitude and a policy perspective that I have previously termed a growth neighborhood, and I think that this played an important role in the region's shock absorption capacity and resilience. Of course, China is by far the largest absolute contributor to the increase in the GDP of the region. With the kind of growth that China has achieved over the past several years, every other economy in the region, as well as outside, would gain from greater access to the Chinese economy. Slide 8 shows just how significant trade with China has become for other countries in the region. The share of exports to China from virtually all these countries has gone up by multiples over the past decade, even as these economies have remained significant exporters to the US and Europe. Purely from this pattern, one could conclude that a fast-growing and resilient Chinese economy can act as an engine of recovery and growth in Asia. This is the context in which I emphasize the significance of the massive fiscal stimulus initiated by China in late 2008. In growth terms, it would not only stand to benefit the Chinese economy, it would also spill over into economies who are significant exporters to China. But the argument does not end there. There has been an ongoing debate about the so-called supply chain aspect of regional integration in Asia. The argument is that a lot of exports to China from other Asian countries are driven by a regional supply chain that eventually feeds into the US and European markets. If these markets remain sluggish, then exports from China can also stagnate, and this feeds back through the supply chain to other Asian economies. While there is perhaps some merit to this argument at the level of individual industries, I do not believe it makes a compelling case at the macro level. One way of testing the hypothesis of self-sustaining regional integration is to examine how exports from the rest of Asia to China behaved while the Chinese economy itself was recovering, even as its exports to the US and Europe were not. The numbers on slide 9 provide some information on this. The numbers in the table on slide 9 are the seasonally adjusted month-on-month growth rates. I have not annualized them from each of the countries to China during the periods indicated in the columns. The middle column reflects the bottom of the trough, and the numbers clearly show that exports from the rest of the region to China were actually declining. However, by about the middle of 2009, these numbers began to turn positive for many of these countries and have continued to sustain. The third column reflects the relatively reflects the fact that the relatively strong turnaround has persisted. The point I would like to emphasize is that this turnaround began at a time when exports from China to the US and Europe were themselves still relatively sluggish. On the face of it, they do raise doubts about the predominance of the supply chain factor in regional integration. Based on this kind of analysis, at least I would conclude that the growing regional integration helped to transmit the recovery and growth impulses in the largest economy in the region, and perhaps others as well, to the rest of the region. This contributed to the region's resilience in a situation in which its primary export markets were yet to recover. Let me conclude with some implications from these arguments. I've tried to explain the ability of the Asian region to absorb the recent global shock and emerge from it with relatively little disruption in terms of three sets of factors. First, policy capacity and response. Second, financial buffers. And third, regional integration. Let me now draw a few implications for economic policy in the region from these hypotheses. With respect to the issue of policy capacity and response, the clear implication is that the capacity that has been used up in dealing with the recent crisis needs to be replenished as quickly as possible. This means a steady withdrawal of various stimulus measures and the restoration of normalcy, however it is defined in the fiscal and monetary policy parameters. It is very easy to act aggressively in a crisis situation. However, exit in a non-disruptive way is a far greater challenge. Any action, whether fiscal or monetary, which reduces demand is potentially damaging to the recovery if all the assumptions underlying it do not materialize. The persistent turbulence and uncertainty outside the region do not make things any easier. Nevertheless, the fast recovering economies in the region need to continue in their return to neutral policy positions, which is the only way to regain the capacity to deal with another crisis. From this perspective, the objective of reaching a neutral position must, as far as possible, not be compromised by short-term compulsions that may point to actions in the opposite direction. On the issue of financial buffers, the value of basic banking as the cornerstone of a stable financial system has been highlighted by the crisis. Certainly, this capacity needs to be preserved and strengthened. Early indications are that the regulatory response in countries whose systems are worst affected by the crisis will also move their systems in a similar direction. But we must also remember that the fundamental challenge of financial development in an emerging economy context is to fulfill the needs of a growing and diversifying economy with a combination of efficiency and safety. The future trajectory of financial development must look for a sustainable balance between the two objectives, resisting the temptation to rest on the laurels of its past safety record. As regards the role of reserves, I have already pointed out that even as insurance, particularly self-insurance, which the reserves represent, is an important component of a shock absorption system. But rather than looking at them as the only option, we need to explore alternative mechanisms involving national, regional, and international components. The objective should be to achieve the same degree of protection without the larger macroeconomic consequences that a strategy based exclusively or predominantly on reserves has. Let me conclude by saying that as the world looks for lessons for national and international policy from the crisis, I think that the Asian story will provide some critical ones. In this talk, I have tried to put forward a set of hypotheses about why Asia performed the way it did during the crisis. I hope you found the presentation interesting. Once again, I thank the organizers for inviting me and the participants for giving me a hearing. Thank you.
Well, look, thank you very much for a very interesting and stimulating lecture. Let me begin just with one question and then throw things open to the floor. I was wondering what the implications of these hypotheses were for exit strategies in the region. And is the implicit message that central banks in the region are behind the curve in terms of normalizing interest rates? Just to be provocative.
That's a question the media usually asks me. So, no, I think the implication I'm trying to draw is that there is a normalization is process is so mandatory now. It is required. But I've been arguing in some of my media commentary in the last few weeks that it's not a curve anymore; it's a band. That in any position there are significant downside risks still visible. So if we do accommodate that the assumptions underlying any action are still rather tenuous, that rapid action is a little difficult. So I think when you look at the risks inherent in the curve, and which makes it a band, my preference is always for less aggressive action than for more aggressive action, even though if you were to take a sort of single point forecast, you might conclude that faster action is warranted. But in our policy calculations, the last of which was done in April, towards the end of April, the sense that things were still quite unsettled was very much in play. It did not, have a tangible component. We saw that materialize a few weeks later. But I think that's indicative of the sort of caution with which we will look at changes. So the normalization process, I think, is a given. It's really the risks influencing the pace.
Thank you. Questions?
My name is Subodh, and I work in City and Interested Strategy. My question to you, as you talked about normalization of rates to coming to neutral rates. So what do you think is a neutral rate for India?
I think it's the rate that is consistent with the economy growing on trend and inflation being low. You wanted a definitional answer or a numerical answer? Well, I'm sorry, I can't give you one.
Next question.
I just want to ask Stavros Yanuka with Lee Kuan Yew School. I want to ask a question. I want to stand a little bit on one of the slides that you showed, whereby you showed the ratio of loans to deposits, and ask the following question: given that the financial crisis essentially started as a housing market crisis, I wonder whether it's not so much the ratio of loans to deposits that's important as it is perhaps the simplicity of the banking model, and that Asia was served well by the fact that the banking model was relatively simple, well understood, and therefore you could trace loans back to assets, rather than what we saw in the U.S. and in some European countries, where it was perhaps the traceability that was at issue rather than where the money was being put against. I just wonder if you could comment on that.
That's why I said that this is really, one out of several ways in which one can demonstrate the safety of the banking system. I did mention in my remarks that the links between the sources and uses is sort of one indicator of safe banking. This is one possible way to demonstrate that. With respect to housing, again, it's the loan-to-value ratio of housing loans is really a key determinant of the riskiness of housing finance, and at least from the Indian experience and anecdotally from some other Asian markets, this value tends to be relatively low. People don't borrow typically 100% or 90% of their values. They borrow maybe 60 or 70%. So there's a cushion there in terms of risk for both. The homeowner always has equity, so he's unlikely to default except in distress, and the lender has the security of that arrangement. But I think there are a number of different dimensions to this safety, and this linkage, I think, is at the core of it. That ultimately every loan is sort of visibly attached to asset. The circuitous nature of intermediation is not there. That doesn't mean that did not provide a very productive service in a certain context, and we need to learn from that also, because you can get trapped into overly simplistic financial systems at a time when the economy wants more, and things like long-term savings for pension purposes and so on. I think there is an emerging gap there which the system needs to respond to.
Could I just ask in that connection, I mean, you seem to be emphasizing the role of safe and, in a sense, narrow banking. If you look back at the Asian financial crisis, these simple banking structures didn't do such a good job intermediating funds, managing risks then. No. Is it the structure, or is it related, for example, to learning some of the lessons from the Asian crisis, and or the fact that in several of these countries there weren't large expansions of credit ahead of the global crisis? Is it the banking? Is it the financial structure itself?
No, I think it's. Looking back at that period, and again there I would emphasize the fact that the impact across countries was quite differentiated. So while we've called it an Asian crisis out of convenience, clearly there wasn't a sort of regional shock here. It was essentially a shock which reverberated with greater intensity in some systems because those systems had common characteristics, but other systems did not feel the same impact. And I think the reason there is, as you're saying, that this balance between risks and exposures, between the risks on the liability side and the risks on the asset side, did not match up. And the simple story of the problems in Thailand and Indonesia in particular, perhaps Korea also, is that a lot of borrowing from outside was sort of mandatory obligation. It was loans that were coming from outside, and money was going into riskier businesses domestically, real estate, equity, and so on. So that was a mismatch that clearly the regulatory system learned from and then put firmer boundaries. Similarly, here I think what we've got is a situation where perhaps those boundaries, but also I think that may have been a lesson. But there's also a legacy effect, which is that intermediation in these economies is still far more bank oriented, and again there we can do various comparisons to show this. And if that is the case, then you're getting the built-in protection that a banking system offers because of the way it does business. So universal banks are of course starting to emerge, and balance sheets are getting more diversified, but they're not to the point where the vulnerability of a shock is so severe. And that may be a lesson. So I think that safety has sort of gained a little more legitimacy in the scheme of things now, which may be a good thing.
Dipinder Randhawa from the Risk Management Institute at this university. I'm going to play the role of a devil's advocate for a moment and pick up on the last point Charles made about your advocacy of safe and narrow banking. It's been borne out very well by the experiences of Canada and Australia, and by individual banks, Banco Santander and a couple of other instances. But if you look at economies, growing economies like Vietnam, Indonesia, India, where there's a colossal deficit of funds for infrastructure, for instance, banks are clearly incapable of providing those funds. You need to go to capital markets and go for innovative financial instruments, some form of securitization, as well as mediate funds from the private and official sectors from overseas. And that's going to call for a rethinking of the paradigm of narrow banking. So if I were to ask you to look at into a crystal ball, where do you see things going, and what are the sources and the avenues through which these funds could be mediated?
Right. Well, I did draw the implication that I did draw in one of my implication statements did say in one of my implication statements that the narrow banking model should resist the temptation to rest on its laurels. I think the fact that it has served, that it showed the capacity to absorb this shock without suffering, complete dysfunctionality. That was a very critical attribute in terms of passing through the policy stimulus, in my view. So the fact that the banking system remained in a position to transmit the monetary and the liquidity stimulus was a key attribute. I don't think we can afford to lose that. We cannot afford to have a system which, because of balance sheet impairment or balance sheet vulnerability freezes up in a crisis. I think that's a key lesson. But that doesn't mean that that's enough. And I think the issues that you raise, which is massive, infrastructure is one. I'm from the other side, from the demand side, I'm looking at pension funds. We know that in these countries, the state cannot afford to bear the full liability of social safety nets. So the financial system has to contribute. So there are requirements there which call for some sort of, not just some sort, but very systematic, market mechanisms. And I think that's understood as far as I'm concerned. I'm not at all questioning the need, the relevance, the sort of utility of these mechanisms. But I think the learning is that they have to be far more effectively, far more transparent and far more subject to scrutiny. So that balancing act between innovation and stability, I think, is important. So we could be looking at implications for a greater degree of regulatory coordination, because each of these activities is more efficiently regulated by specialist regulators in some context, but some degree of coordination. We could be looking at when it comes to things like infrastructure, just a more a greater balance between banking, specialized banks, which is something that in India we're talking about now, and market instruments, rather than depend entirely on one or the other. The development of long-term debt markets has been a sort of hanging issue that's been hanging in India for the last 10 or 15 years. That has received some revival in the context of infrastructure funding. I'm quite involved in that process now, just figuring out ways of getting it working. So many things. There's no one solution. But I think the point you make about not being able to rely on the narrow banking system, however valuable it is in the context of shock absorption, I think that's very valid. But we have to build around it rather than look for a sort of replacement or a substitution.
At the back here.
Well, sir, with regard to your slide 9, which raised my concern, with regard to the only India is misperformed. Now, you did not enlighten us with the attribute factor, and particularly with regard to, even though you have undertaken quite a number of dialogue with Indian intellectual thinkers and so on, but the magnitude of problems remain to be until now, particularly the SME and the all those paradigms that you covered. So, do you intend to overcome it, and how do you find to lead way forward from here? What do you think would be the right recipe in terms of the art, craft, and science of sustainability?
Are you talking specifically about India, or?
Yeah, in India, for India. Yeah, vis-a-vis the others.
Yeah, well, just as a matter of distribution of time, I'm giving up a talk on India tomorrow, so I promised my hosts that I wouldn't talk about India in this to avoid overlap. So I kept this at a reasonable level. I mean, the reason that number is relatively low for India is that Indian exports to China are dominated by minerals, and valuations play an important role in this. So India is really not part of that story in the same way that the other countries are. But on the other hand, the Indian domestic market is far more significant. So the recovery is being driven by domestic sources. But the problems you raise are sort of, they were there before the crisis, and they persist after the crisis. I think what is at least reassuring is that the crisis took our attention away from the structural problems for a couple of years, and the policy process became very focused on how to get out of the crisis, which it seems to have done fairly successfully. So we now turn our attention back to those structural issues. Now we have been addressing them in some way, solving something else comes up. That's an ongoing process, and I can't say to you that they're not very central to our concerns, particularly in SME financing, which is something that, as a result of the experience of how this sector was affected by the crisis, we moved to, or moving towards a different structure. One of the aspects of that structure is a credit guarantee trust, which is essentially a way to ensure that small enterprises will continue to, will not suffer the consequences of individual, problems in payment. We used to have a structure called Deposit Insurance and Credit Guarantee Corporation, which I'm the chairman of. But the credit guarantee part of that faded out for various reasons. That function has now been reinstituted. So essentially what it's telling SMEs is that, look, if we recognize that you have a problem because of a business downturn, which is really outside your control, then you have a safety net that, you will not be squeezed out of access to finance if you have that problem. So I think there are basically the implication of the crisis for SMEs. This is a very important manifestation that, credit guarantee is now fallen out of fashion, is now come back in a hopefully more viable form, which requires some sort of insurance premium that is being collected by, I forget the details, but so this is a way in which we think that some of the structural issues get a little bit insulated from the crisis, from the sort of very intense kind of shock.
One very quick.
Yeah. No, because you seem to be from S&P, but you notice a point of curiosity that, the index S&P, for example, the Indian index doesn't appear, non-existent. Why the reason is S&P are not, acknowledging the possibility of a new world? We're talking about G20, but then, why is S&P? You belongs to S&P before. It doesn't come to their mind to include it.
Well, the key is that I belonged to S&P. I don't belong to S&P anymore. So I have a friend, a former colleague in the audience, but I really can't speak on behalf of my former organization.
Okay, we have a question over here.
Of the three sort of basic shock absorbers, you also had fiscal stimulus in there playing a big role. And in following up to Charles's question, you said that still going a bit slow on the rollback in the the monetary policy. But on fiscal policy, I mean, what's your sense? Because we at the public policy, my name is Shrikant Gupta, I'm at the LKY school. The idea is that, we think about good governance and we know all about, we don't teach public choice here, but about budget maximizing bureaucrats and so on. The idea is that, don't you see that as a huge problem, or in a sense making a virtue out of necessity? To give you the specific example that you and I would know about, the pay commission, which is this big hike in public expenditures, came as a kind of you made a virtue out of necessity, saying, oh, well, this is now a fiscal stimulus. And we had all the Financial Responsibility Act and all that sort of gone out of the window. And so my specific questions to you are, number one, do you see the same hesitancy in the government in rolling back the fiscal stimulus, reducing the fiscal deficit, which to my mind is a huge threat to the Indian economy in particular? Not so sure about the others. And the second point is that do you see in this a kind of a strategizing in terms of fiscal irresponsibility now being called fiscal stimulus?
Well, since I'm a direct beneficiary of the pay commission, I'm not going to knock it. I think in retrospect, it came at a time when it was most needed, so almost serendipitous kind of implementation, and to my mind really constitutes the most significant component of the expenditure stimulus to the Indian economy. Just to keep the time frames, the timelines in mind, it was implemented in tranches starting October 2008, and so there was roughly a 40% average pay hike to government employees, and 2.5 years of back pay that was paid out in 2 or 3 tranches. And when we look at the response of the industrial sector in the months following, it seems fairly obvious that a lot of this money got spent on consumer durables, on automobiles and so on, which sort of helped the economy recover. In retrospect, had that scheme, that agenda been implemented in a time of full of rapid growth, I think it would have had a serious overheating problem, but it came, perfectly timed. Now it's not stimulus because it's a mandatory, it's a commitment, and it would have been done regardless of economic circumstances. But that it came at a time when the stimulus was needed, I think, gave it that added boost. But I think the second issue which you raised, which is commitment to roll back and so on, is hugely facilitated by the fact that the recovery has been so strong, and there is pretty decent revenue buoyancy. There is you get more than unity response to growth in terms of tax collections. There is a greater comfort in sort of saying no to expenditures which otherwise would have been difficult to say. There is still some fragility in terms of the recovery of private spending, but that's starting to fade, at least in the build-up to the current environment, which of course has put we're seeing stock markets and exchange rates and capital movements become very, very volatile in the last few weeks. So that's bringing a new dimension of uncertainty. But up until that point, till the end of April, I think the sense that the private sector was starting to get back on track, and therefore the recovery was less dependent on public spending, was starting to consolidate. So I think I certainly have a sense that the recognition that the stimulus the overhang has to be pulled back pretty fast is there, and it's showing up in the numbers and showing up in the rhetoric. But it's obviously spread over a period of time, so we don't know how events are going to unfold during that time and what pressures emerge at times when you actually have to make the decision. So I think that's a risk that we will live with. But ultimately, it's growth. If growth is 8.5%, which is as of now, I would say the model forecast for 2010-11, I don't think it's going to be very difficult to roll it back, because revenues will catch up, and the revenue base now is getting wider and wider because of the VAT. I think the VAT was an extremely successful instrument to bring people into the net voluntarily. I think the GST, although it's still a little bit difficult to implement, will reinforce that tendency. So I'm not too worried on the ability to roll back without too much sort of expenditure cutting, as long as the growth is sustained.
Thank you. We have a question here. I guess one of the issues there is, are we sanctioning promiscuous fiscal policy by virtue of the kind of messages that the international community was delivering during the crisis?
Interesting. I think I've just come in from the G20 meetings in Busan, and that was clearly not the message, because I think one of the sort of interpretations of what's happening in Europe is that you can really sort of suffer from having overreacted to a crisis also. Whether this was, in a crisis, you don't see it as overreaction, you see it as, do anything that can be done to solve the problem, and then worry about the consequence later. But these are the kind of consequences that come later, which you have the capacity to deal with simply doesn't exist. And I think this is really a sobering fact that ultimately the fiscal tool itself is limited, in the sense that it has a short-term impact, but it also has significant, potentially sort of dangerous aftershock is what I call it, and that recognition seems to was certainly very visible in the G20 discussions.
Two questions, one here and then here.
Rajan Govil from the International Monetary Fund. Quick question. Do you think in Asia, or in whatever parts of Asia, the cost of living is being correctly measured by the different price indices? I know there are lots of problems in India, but in China we've seen recently although the inflation number is around 2 to 3%, but we see wage increases in the order of 20 to 30%. So really, are the central banks maybe not measuring the cost of living that accurately and giving themselves a pat on the back that, you know, they're not really behind the curve? Thanks.
Well, I think that is also a structural problem. It is a problem before the crisis. It's a problem after the crisis. We may never measure the cost of living because you're revising indices every 10 years, and you know the structural economy has changed so dramatically during that time. I was actually involved with the technical process which was trying to rebase the wholesale price index, and I was both there as a professional, in a professional capacity, and as a representative for Chamber of Commerce. They wanted Chambers of Commerce to provide inputs into whether the price of certain new products could be adequately, effectively measured, and with some history. And it turned out to be a huge problem because the nature of these products is evolving so rapidly. The market structure is very fluid, and you know people are coming in and going out of business very at high frequency. So it's very difficult to capture any kind of history, meaningful history of price movements. So that is a perennial problem, I think. So we may not be measuring the cost of living correctly, but I think that doesn't necessarily reflect the cyclicality of the pattern. That is a parallel structural issue which we need to deal with. But if you're using a common index or the same index right through, then I think you can only evaluate your sort of the appropriateness of your actions in terms of that index. And I don't see a problem with that. You may have a inadequate speed measure, but at least as long as you're using the same gauge, the same dial, I think you're okay. And coming back to the behind the curve issue, I think it comes back to the security that you have on the curve as opposed to the sort of range of possibilities that you have around it. As an outside analyst, I saw the curve, and I was always it was easy for me to make a judgment that, you know, the bank is ahead of the curve or on the curve or whatever. But that perspective changes when you're looking at the sort of range of inputs you're getting on how fragile the curve itself is. So I go back to my point, my response to Charles' question, which is that there's no reversal in this process. You can't, you know, make a move on the basis of certain expectation, and then 3 months later, a bunch of guys says, "Oh, sorry, we were wrong with the forecast, and we're scaling it down to 2 percentage points less. So, you know, can we go back?" We can't go back because you've set a process in motion. So I think that's the difficulty in the decision making. It's just a range that you have to operate within. And I did the same thing when I was forecasting. You know, I would put a number out this month, and a month later I would say, "Sorry, I was wrong. I'll put another number out." But we can't make policy on that basis.
We have a question here. One question here, and then the second one there.
Hi, I'm Elena Grachenko from Standard & Poor's, and I have a quick question.
So you know who to ask your question to.
Right. The implications for the future of the theory that you've presented and the shock absorbers. With what's happening in Europe now, the sovereign debt crisis and potential implications for the European banking system, the slower growth, the weaker euro, we may be in for another period of slower growth, maybe even another period of recession. What's your view whether Asian countries will be as effective in absorbing this new shock this time round?
Yeah.
Or will you see more risks if another bout of recession were to come?
I think the general principle I would apply here is that you know, if you the ability to deal with shocks depends on capacity as well. So that's why I was emphasizing the need to create that or replenish that capacity as soon as possible. And without that, the vulnerability to even a smaller shock increases, because, you know, if you don't have the response capacity, it can do damage. So I'm concerned that an aftershock, even of lesser intensity, can still do severe damage. The channels that I'm seeing as possibly transmitting this are the same channels, which is the essentially the financial and the confidence channel. The trade linkage, it hasn't recovered anyway, and the domestic and the regional drivers are sort of at this point driving the recovery. So I don't see the trade issue as being terribly significant at this point. But the finance channel, I mean, we're looking at this huge increase in volatility now at a time when people are already nervous about, business prospects and investment, and I think that can do some damage. So I don't I'm not operating under the belief that this will not have an impact if it persists for very long. In the build-up to our policy decision in April, we had meetings with many banks, including some international banks, and everybody told us capital flows into India are a done deal. It's just going to come in like there's no tomorrow. So you better be prepared for it, and actually advocating, or if not advocating, certainly raising the possibility of capital controls and so on. And 1 month later, the situation is very different. The people were complaining about rupee appreciation. Now it's sort of depreciated about 7-8% in the last 1 month. So that's a shock. When your expectations are not being met, you tend to sort of take a step back and start reevaluating. And I think that's happening. So it could have a real impact, and it could have an impact particularly on investment activity, which I think is the great vulnerability. So I was outside the system when the 2008 crisis hit, but I was close enough to business to realize how much of an impact liquidity, the shortage of liquidity could have on businesses. It was very, very tangible, visible impact. And that's, I think, something I'm very worried about as a policymaker.
Thanks. We have time for one more question. Adam?
One shock absorber that you haven't discussed, which I guess is probably the most obvious one when you're comparing Asia in 97 to 08, is the role of exchange rates. In 97, fixed exchange rates were part of the problem. In 08, far more flexible exchange rate regimes were probably part of were significant parts of the shock absorption system. So I got two follow-ons from that. Firstly, is there a realization, do you think, or amongst Asian policy makers, I'm taking China out of this, that actually the ability to allow the currencies to absorb some of the adjustment was actually a significant shock absorber in this downturn? And if so, do you get a sense that sort of the fear of floating is, as a result, becoming less fearful?
You pointed out the reason why I didn't classify it as a regional sort of shock absorber, because it's not a regional shock absorber. It's more of a country-specific with variation shock absorber. So you're right that there is a difference in the attitude or the approach to exchange rates, where some amount of volatility is now not being seen as terribly destructive, partly because I think the mechanisms to mitigate that risk are starting to, if not reach a mature state, certainly starting to become visible. But the China factor is clearly a consideration here, and as I'm saying that not only these countries are competing with China in third country markets, they're also getting more and more integrated with China, which is the point I was making here. So I think the exchange rate policy becomes a little more complicated, and the game it's a very interdependent kind of game. So in India, at least, the debate is very, very vocal. That there is a very strong lobby of people who were arguing that we were just letting ourselves appreciate a way into non-competitiveness. And others were saying, well, floating exchange rates are really the pillar of your financial sector reform agenda, so you can't be mucking around with them when it's convenient. And of course, now that the picture is turned. But I think you're right that there is the shock absorption recognition the recognition that exchange rates can be a shock absorber in individual country situations, particularly small country situations, I think, because that doesn't have too much of a spillover. is there, and we're clearly seeing it in the European debate now, that locking into an exchange rate mechanism without the initial conditions being appropriate, or without operating within a relatively narrow boundary of fiscal and monetary parameters, I think that risk is visible. So there has been some impact with the volatility of exchange rates between 2008 and 2010. First sharp depreciation, then appreciation, I think was a shock absorbing factor. But it's not, to my mind, yet, until the region as a whole, starts to behave in a similar fashion. I wouldn't classify it as a regional shock absorber, which is, in a sense, why I didn't sort of focus on it here. But thanks for pointing that out.
Thanks. Well, look, maybe if I can just conclude with one question about something we've alluded to several times during the the lecture: global rebalancing, and particularly Asia's role in global rebalancing. My two questions. Number one, in terms of thinking about the growth of intra-regional trade, which you see as part of one of the regional shock absorbers, how do you see Asia's role in global rebalancing? Do you think Asia needs to make a significant contribution? And number two, given the problems in Europe, which will presumably induce much more rapid fiscal adjustment than otherwise, and perhaps Europe going into a bigger current account surplus, is that going to put even more pressure on Asia to rebalance?
I think there is a sort of a trend which will sort of have its impact regardless of any actions taken by governments. I think the demographics, the income dynamics are all going to contribute to rebalancing over a period of time in any case. The question is whether this process will happen at a pace that the system can accommodate, or whether it's going to be too slow to actually, or if it's too slow in the intervening period, are these the sort of negative impacts of it going to sort of offset any benefits? So I think there is certainly a case for a more active rebalancing strategy to reinforce this trend. The trend is there, but it perhaps needs to be reinforced. And when you talk about interventions to reinforce it, obviously some management, both domestic management and sort of international management issues come up. But I think the same thing I think applies to Europe in a sense, because in the opposite direction, because the demographics there point to a kind of a trend, if not slowing down, certainly of relatively stable growth, not accelerating growth, which is not the case with India. So there again, the fiscal adjustment, which is a little more abrupt than would otherwise be warranted, may sort of reinforce that trend, and you've got to find ways of mitigating that. So I think the sort of if not comfort, at least the sort of relief is that both of these adjustments are really more in the way of reinforcing existing trends rather than militating against them. If that were to be the case, I think we'd have a far more difficult rebalancing process. And so the decision variable is really on speed, not on direction.
Okay, well, look, thank you very much for a very stimulating presentation. And maybe if we could just show our appreciation. Thank you very much.